I'm Alastair Sewell, and I'm head of Fitch Ratings Fund and Asset Manager Rating Group for the EMEA and Asia Pacific regions. I'd like to start by thanking Ned Group Investments for having me here again. I had the pleasure of participating in the very first of these conferences 10 years ago, albeit in person. So it's great to be back with you again virtually this time. There are two topics I want to talk to you about today about the cash investment market worldwide. And those are first, the rise of responsible investment, and second, the current areas of regulatory attention. So responsible investment. I know you're all talking about responsible investment yesterday, and it is clearly a very important theme for many investors around the world. So it will come as no surprise to you that responsible investment has now made its way into the short-term markets as well, has made its way into money market funds, into cash investing. And in fact, around the world, we have seen a large number of money market funds either converting to an explicit environmental, social and governance or ESG strategy or new funds being launched. And in fact, these funds have generated quite a lot of assets. So the question for a cash investor is, how exactly are they doing this? What is it that they're doing to make a fund ESG? And the primary area of focus seems to be that fund managers are placing ever greater emphasis on governance, the G from the E, S, and G factors. Now, in many ways, this is not really a change because governance has always been a key part of any credit analysis process. But what this ESG movement has done is it has brought that governance and environment and social as well, brought this governance pillar into greater focus in investment processes and made it more of a significant lever or area of investigation for fund managers in making investment decisions. So for those of you for whom ESG matters as part of an investment approach, the important thing to do is to interrogate your fund manager, to take them to task, to understand exactly what they're doing to integrate ES and G. And in the short-term markets, it's probably going to be on governance. So that is your area of attention. Now, this ES and G focus has not been lost on regulators either. And there is growing regulatory attention on how fund managers are applying ESG processes in a consistent manner. But what is of more immediate concern to money market fund managers and cash investors around the world is how the March 2020 market stress period may translate into new regulation for money market funds. So as some of you may remember, there's already been several fairly significant rounds of reform to money market funds following on from the 2008 financial crisis. And then, of course, in March 2020, there was stress again. Now, this stress did affect money market funds, less than in 2008, but there was enough stress to trigger regulatory interest. In the US, there are regulatory reform proposals on the table. And in Europe, regulators are currently consulting on reform proposals. There's not enough time to go into all of the proposals here and now, but the one I do want to highlight to you is a headline change to the structure of money market funds. After the financial crisis in 2008, the US regulations moved some types of money market fund from a stable unit value per share, 1 rand in, 1 rand out, very simple. They moved to a variable price. So rather than getting a rand back, you might get a small fraction different from a rand back in a money market fund. And now in Europe, in the latest consultation, there is the suggestion that that money market funds may be forced to move to a variable price as well. And what's underpinning this is investors' focus on investor behavior. And I know investor behavior will be a topic of conversation for you tomorrow. But what they're interested in is the incentives for investors to redeem earlier. And if enough investors redeem together, for that to cause issues for funds or indeed for the markets more broadly. And the hope is that by moving to a variable price per share, along with some other reforms, they may be able to mitigate the risks arising from this investor behavior. So from an investor perspective, and if this regulatory scenario does play out and lead to funds moving to a variable net asset value per share, some adaptation is likely to be needed and potentially in the relatively near future. And by that, I mean probably next year or later for those investors, at least in Europe and the US. So with that, I will conclude my remarks and to summarize that responsible investment has now made its way into the cash investment arena, and that regulatory reform, re-reform, in fact, is back on the agenda. Thank you very much for your attention, and goodbye.